Like many of you with kids, ours were recently on spring break. After battling the crowds last year at Disney, my wife and I wanted a calmer and more active experience. So we packed our bags for Costa Rica for a week of outdoor adventure. And unlike my previous trip there in 2003, I didn't come close to dying from a tropical disease. So, all in all, the trip was a resounding success. Equally important, stepping away from the daily headlines proved to be a valuable opportunity to reflect on some bigger picture themes when it comes to investing in markets. Does the conflict with Iran matter? Well, of course. But will it matter as much in a year from now? Doubtful. A global crunch in energy and derivative commodities is unsustainable, and thus it's unlikely that today's status quo will be sustained. Now, that's not to dismiss the possibility for near-term volatility and perhaps an enduring revaluation higher of energy assets. But when it comes to driving markets, we think the myopic focus on the Strait of Hormuz is bound to give way to factors shaping the longer-term trajectory of the economy and U.S. businesses. And in that spirit, we're going to return to discussing artificial intelligence this week. One persistent theme is that the demand for compute continues to grow unabated, as does the demand for the infrastructure to support it, from power generation to networking, memory, and chips. If you've been using any of the major AI models lately, especially Anthropic's Claude, you may have noticed that at times it deteriorates in terms of user experience. Slower responses, usage caps, sometimes even less reliability. That's not a bug as much as it's a symptom of the company struggling to serve accelerating demand growth. This year alone, Anthropic has grown from $9 billion in annualized revenue to over $30 billion today. Every one of those dollars represents demands for GPUs, networking equipment, and the electricity to run them. Today, the US has an estimated 25 to 40 gigawatts of data center capacity installed, accounting for about 4% of electricity demand. OpenAI is talking about adding that much in a single year soon, not to mention the needs of its AI peers. Adding gigawatts of compute capacity per month means not just more chips and servers, but the electricity infrastructure that needs to be built alongside them. That's driving a massive investment cycle across both the semiconductor and power supply chains that we think is sustainable and necessary in order to support customer demand. While demand continues to accelerate, the models themselves are also taking a leap forward. For instance, Anthropic just previewed its newest model, Mythos, which it called a step change in capabilities dramatically better at reasoning, coding, and autonomous problem solving. Likewise, OpenAI is rumored to be following soon with a major upgrade to its GPT 5.4 model. As for Mythos, during testing, the model discovered thousands of critical security flaws across major operating systems and web browsers, including bugs that had survived millions of automated tests. Anthropic claims the model is so capable that it's irresponsible to release it publicly for now, instead giving early access to companies like Microsoft, Apple, and JP Morgan to shore up their cyber defenses. It was significant enough that Treasury Secretary Scott Bessent and Federal Reserve Chairman Jerome Powell convened a meeting with major bank CEOs to discuss the implications and proactively encourage defensive precautions. The security risks are real, but we think manageable, and frankly, a model that can find vulnerabilities that humans missed for decades is exactly the kind of tool one would want for defense. More broadly, we think these capability leaps are a net positive given the productivity enhancements they promise to unlock across industries. And that's what makes this investment cycle so compelling. Despite the promise of AI, equity valuations have corrected meaningfully, driven by concerns over the Iran conflict and fears that AI could disrupt entire industries and displace jobs. In short order, the S&P 500 and large-cap tech firms have pulled back to their 5-year average valuation levels. The key questions investors are grappling with is whether AI will be a destructive innovation or an enabling one. For now, the destructive camp is winning the narrative, but we think that will change. There will obviously be some disruption, and markets are quickly pricing that in, particularly in the software sector. But we believe that AI fundamentally represents an opportunity to accelerate growth. Firms wouldn't be spending billions on building out AI infrastructure and on AI services if they believed they were spending themselves out of existence. They're seeing real productivity returns, and we're starting to see that in the macro data. US labor productivity grew 2.2% last year, above the prior cycle's 1.5% average. We're not saying it's all AI, but it's hard to ignore the timing. If productivity is genuinely inflecting higher, that flows through to margins, earnings, and ultimately equity prices. In short, we see more reasons for optimism longer term than the near-term pessimism reflected in markets. And that near-term pessimism has created some real dislocations. As of Monday afternoon, the S&P 500 is essentially flat on the year, but that headline number disguises a fair amount of carnage underneath. Many quality large cap stocks have drawn down 20, 30, even 40% or more from their 52-week highs. In some cases, that's warranted, as fundamentals may have deteriorated. But in many others, we think the sell-off has been too severe or that current prices don't reflect the scope of firms' opportunity sets, and that's where we're spending our time. As always, please feel free to reach out with any questions. Thank you, and have a great start to your week.